Have you ever heard a piece of economic news that just didn't add up? Where the supposed solution to a problem actually seems to make it worse? Well, for decades, economists were stuck on a puzzle exactly like that. Today, we're going to unravel it, and it's a fascinating story. So at the very heart of this mystery is a massive contradiction. For years, it made it look like the most powerful weapon we have for fighting inflation was, well, completely broken. It's a puzzle that seems to fly in the face of basic economic logic. I mean, just think about this for a second. What if the number one tool in the toolbox for cooling down a hot economy was actually fanning the flames? For a really long time, that's exactly what the economic data seemed to be telling us, and it created this huge headache for policymakers.
Right. It's pretty much economics 101. The central bank wants to slow things down, so they raise interest rates. That makes borrowing money more expensive, which means people and companies spend less. Demand cools off, and inflation, well, it should go down. It's supposed to be a straightforward cause and effect thing.
But here's where it gets weird. For years and years, when economists plugged this exact scenario into their super sophisticated models, they saw something that made no sense at all. After a simulated interest rate hike, prices didn't fall. They actually went up. This was so bizarre and so consistent that it even got its own name, the price puzzle. And look, figuring this out wasn't just some academic game. It was absolutely crucial to know if our economic policies were actually working or if they were backfiring.
Okay, so to get to the bottom of this, we have to look at the tool everyone was using. Let's call it the prime suspect in this whole mystery.
That tool is called a vector autoregression model, or VAR for short. Now, the main thing you need to know about it is that it's completely backward-looking. Seriously, imagine trying to drive a car forward by only looking in the rearview mirror. That's kind of what this model was doing. It crunches tons of past data, prices, production, you name it, but it has this one massive blind spot.
And hey, don't just take my word for it. The authors of the paper we're looking at today put it bluntly. They said the model's biggest weakness was that it just didn't get how a central bank actually thinks or reacts. It was missing a huge piece of the picture.
So here's the problem in a nutshell. The model could see the past with perfect clarity, but it was totally blind to the future. See, central banks don't just react to what already happened. They act based on what they expect to happen. They raise interest rates today because they see signs of inflation coming down the road. The old models, they miss that whole element of anticipation.
And that blind spot, that's exactly what created the puzzle. The paper shows this by running that old model. And what happens? An interest rate hike, which is supposed to fight inflation, leads to, yep, even more inflation. There it is, the price puzzle, clear as day in the data.
This leads us right to the paper's brilliant insight. What if we could just fix the model's vision? What if we could give it the ability to look forward, out the windshield, instead of just in the rearview mirror? And that is exactly what these researchers did. They came up with a fix that was actually pretty simple, but totally game-changing. They thought, hey, what if we just feed the model the same kind of forward-looking info that actual policymakers use? So they added two new ingredients designed to do just that. Here's how they did it. First, they added something called the federal funds futures rate. You can just think of this as the market's collective bet, the wisdom of the crowd, on what the central bank is going to do next. Second, they threw in a composite leading indicator, which is basically a bundle of economic signals that are good at predicting future trends. In short, they gave the model a pair of glasses to see into the future. So, the million-dollar question, did it work? Did adding these two little ingredients actually crack the case? Okay, let's do a quick side-by-side. First, let's just remember what the old, backward-looking model gave us. A central bank hits the brakes, and prices go up. The confusing, counterintuitive price puzzle. All right, now for the moment of truth. What happens when you run that same exact scenario, but with the new, smarter, forward-looking model? Boom, prices go down. The model now does exactly what economic theory says it should do. The rate hike works, inflation comes down, and the puzzle, it's gone. And just like that, the mystery was solved. By simply giving the model a peek into the future, the same kind of peek that central bankers and markets have all the time, the model started giving what the researchers called theory-consistent responses. The puzzle was never a problem with the economy itself. It was a problem with the tool we were using to look at it. Now, you might be thinking, okay, cool, they fixed a model for economists, but what does that have to do with me? Well, it turns out solving this puzzle has some really big implications for all of us. Look, it matters because better models lead to better decisions and a clearer picture of the economy. But maybe the biggest takeaway is this. It proves that our expectations aren't just ideas floating around in our heads. They are a real, powerful economic force. What we collectively believe is going to happen in the future has a direct impact on what actually happens today.
And this quote from the paper really sums it all up perfectly. As financial markets get better and better at guessing what central banks will do, those guesses become incredibly valuable data. They give us a much clearer window into how the economy really works. So in the end, this whole giant price puzzle existed just because our tools were missing one single thing: a view of the future. It really makes you wonder, doesn't it? What other economic truths that we all take for granted are maybe just one missing piece away from being turned completely upside down?